If you have any kind of side income in the UK selling online, freelancing, tutoring, dog walking, content creation, delivery work, or anything else, there is one rule that affects you more than any other. It is called the trading allowance. It is worth £1,000. And the truth is, most people who think they understand it are actually using it wrong. Some people think it means they never have to pay tax on their side income. Some people think it resets for every platform they sell on. Some people think it applies to their profit, not their total income. And some people are claiming it when they absolutely should not be, and it is costing them money. Today, I am going to fix all of that. We are going through the trading allowance from the very beginning, what it is, how it actually works, when to use it, when not to use it, and the most common mistakes people make that HMRC will pick up on. Quick note before we start, this is general information, not personal tax advice. Your exact situation may be different, so always check Gov. UK directly or speak to a qualified UK accountant or tax advisor for your specific circumstances. In this video, we will cover what the trading allowance actually is, the gross income rule that most people miss, full relief versus partial relief, when claiming the allowance is the wrong decision, how it works if you have multiple income sources, what the registration rules are, and what is changing with the upcoming £3,000 threshold update. The trading allowance is a tax-free allowance introduced in the UK in 2017. It allows individuals to earn up to £1,000 per tax year from trading income without paying any income tax or national insurance on that income. Trading income in this context means income from self-employment, casual work, gig economy activity, selling goods, providing services, or any kind of miscellaneous income from trading activities. It is designed specifically for people who earn small amounts on the side, people who are not running a full business but do have some income coming in here and there. If your total gross trading income for the tax year is £1,000 or less, the allowance covers it completely. You do not pay any tax on it. You do not need to register for self-assessment. You do not need to file a tax return for this income, and you do not even need to report it to HMRC at all. That sounds simple, and for a lot of people it is. But the problems start the moment people misunderstand the word gross, and that is what we are going to cover right now. This is the single most important thing to understand about the trading allowance, and it is the thing most people get wrong. The £1,000 limit is based on your gross income, not your profit, not what you take home after expenses, not what lands in your bank account after fees are deducted. Your gross income, which means the total amount before any deductions at all. This matters enormously in practice. If you sell on a platform that charges selling fees, those fees are deducted before you receive your payment. So, the amount that arrives in your bank account is already lower than your actual gross income. If you use that bank figure to decide whether you are under or over £1,000, you could easily be making an error. The correct figure to use is the total value of your sales before any platform fees, transaction costs, or other deductions are taken off. That is your gross trading income. That is the number you compare to the £1,000 allowance. So, if your actual gross sales were £1,100, but after platform fees, you only received £950 in your bank, your gross income is £1,100. You are over the £1,000 threshold. And that changes what you need to do. Now let us talk about the two ways the trading allowance can be applied: full relief and partial relief. Full relief applies when your total gross trading income for the tax year is £1,000 or less. In this situation, the entire income is covered by the allowance. You pay no tax, you report nothing, and you have no registration requirement for this income. It is completely handled by the allowance. Partial relief applies when your total gross trading income is more than £1,000. In this situation, you can still use the trading allowance, but you use it as a deduction rather than a complete cover. You deduct the £1,000 allowance from your gross income, and only the remainder is treated as taxable profit. So if your gross trading income is £1,800, you deduct the £1,000 allowance and your taxable profit becomes £800. That £800 is then added to your total income and taxed accordingly, depending on your overall position. The key point with partial relief is this: if you choose to use it, you cannot also claim your actual business expenses. It is one or the other. You either claim the flat £1,000 trading allowance, or you claim your actual expenses. You cannot do both. And that decision, which one to choose, is something we are going to cover in detail shortly. This is the part that most people miss entirely. The trading allowance is not always the right thing to claim. In fact, for many people, claiming it can actually cost them more money. Here is why. If your actual business expenses are higher than £1,000, you should be claiming your actual expenses instead of the trading allowance. By claiming the flat £1,000 allowance when your real expenses are higher, you are reducing your taxable profit by less than you could. That means you pay more tax than necessary. For someone who is genuinely running a small operation, even part-time actual expenses like equipment, materials, software, transport, marketing costs, and professional fees can easily exceed £1,000. In those cases, doing the calculation properly and claiming actual expenses will always give you a lower tax bill. There is also a second situation where the trading allowance is the wrong choice. If your expenses are higher than your income, meaning you have made a trading loss, you should not use the trading allowance at all. A trading loss can be carried forward and used to reduce your tax bill in future years. But if you claim the trading allowance, you cannot create a loss. The allowance only reduces income down to zero, never below it, so using it in a loss-making situation means you lose the ability to carry that loss forward. So, how do you decide which one to use, the flat £1,000 trading allowance or your actual expenses? The answer is straightforward. You compare the two numbers. If your actual allowable business expenses for the year are less than £1,000, the trading allowance is likely the better and simpler choice. You get a higher deduction with less paperwork. If your actual allowable business expenses are more than £1,000, claiming actual expenses gives you a bigger deduction and a lower tax bill. Use actual expenses in this case. If you are not sure what your actual expenses add up to, that is a strong sign you need to start keeping better records. Track everything you spend in connection with your trading activity, because not knowing means you cannot make the right decision at the end of the year. This is another common misunderstanding, and one that catches a lot of people out, especially those with more than one income stream. The trading allowance is a single £1,000 allowance. It is not £1,000 per platform. It is not £1,000 per side hustle. It is not £1,000 for selling combined with another £1,000 for freelancing. It is one single allowance of £1,000 total, applied across all your trading and casual income combined for the tax year. So if you sell on one platform and also do occasional freelance work, all of that trading income is added together, and the combined total is what gets measured against the single £1,000 allowance. If your combined total is under £1,000, you are fully covered. If your combined total exceeds £1,000, you are in partial relief territory and need to register and file accordingly. You can choose how you allocate the £1,000 allowance across your different income sources, but the total deduction cannot exceed £1,000, and you cannot create a loss from using it. Now let us be clear about what the trading allowance does and does not change in terms of your registration obligations. If your gross trading income is £1,000 or less, you do not need to register for self-assessment for this income alone. You do not need to file a return. You do not need to report it to HMRC. The allowance fully covers it. If your gross trading income exceeds £1,000, you must register for self-assessment by 5 October in the tax year following the one in which you earned that income. Even if after claiming the trading allowance, your taxable profit is very small or even zero, the registration requirement still applies because your gross income was over the threshold. This is a point that people frequently misunderstand. They assume that because the allowance reduces their taxable profit to a low amount, they do not need to do anything. But the registration trigger is based on gross income, not on profit after the allowance is applied. The only exception to this is if you are already registered for self-assessment for another reason, such as employment income over a certain level or other self-employment income. In that case, you would simply include your trading income on your existing return. Now, let us talk about the change that is coming because this is relevant to how the trading allowance works in the near future. The government has announced a plan to raise the self-assessment reporting threshold for trading income from £1,000 to £3,000 gross. This is being introduced within the current Parliament, which means before 2029, and the current indication is that it will be implemented from April 2027. What this means in practical terms is that once it comes in, people with gross trading income below £3,000 will not need to file a self-assessment return. This will take an estimated 300,000 people out of the tax return system entirely. However, and this point cannot be stressed enough, this is a reporting and registration change. It does not mean that income between £1,000 and £3,000 becomes tax-free. If your total income across all sources puts you above your personal allowance of £12,570, you may still owe tax on that trading income. You would just be able to pay it through a simpler online service, rather than a full self-assessment return. So the £3,000 update is welcome news for small side hustlers, but it does not remove the need to understand your overall tax position. Let us go through the most common trading allowance mistakes, the ones HMRC picks up on, and the ones that end up costing people money. The first mistake is using your net bank receipts instead of gross income to check whether you are under the £1,000 limit. Always use gross income, the total, before any fees or deductions. The second mistake is assuming the allowance is per platform or per side hustle. It is one combined allowance across everything. The third mistake is claiming the trading allowance when your actual expenses are higher. Always compare before deciding. The fourth mistake is claiming the trading allowance when you have a trading loss. A loss is more valuable carried forward than covered by the allowance. The fifth mistake is not registering for self-assessment when gross income exceeds £1,000. The registration deadline is 5 October following the end of the tax year in which you exceeded the threshold. Missing that deadline can trigger a penalty. The sixth mistake is claiming both the trading allowance and actual expenses on the same return. You can only choose one. If you claim both, your return is incorrect and will need to be amended. Here is the correct process for using the trading allowance properly every tax year. First, keep records of all trading income throughout the year. Every payment received, every sale made. Do not wait until the end of the year to try to reconstruct your figures. Second, at the end of the tax year, calculate your total gross trading income across all sources combined. Use gross figures, not net bank receipts. Third, compare that gross total to £1,000. If it is at or below £1,000, you are in full relief. No tax, no registration, no return needed for this income. Fourth, if it is above £1,000, calculate your actual expenses and compare them to the £1,000 allowance. Choose whichever is higher to minimize your taxable profit. Fifth, if your gross income is above £1,000, register for self-assessment by 5 October in the following tax year if you are not already registered. Sixth, on your tax return, claim the trading allowance in the self-employment section by entering it in the relevant box. You do not claim it automatically. It does need to be actively claimed on your return. Let us bring everything together. The trading allowance is one of the most useful tax reliefs available to UK side hustlers and casual earners, but only if you use it correctly. It is £1,000 per tax year across all trading sources combined. It is based on gross income, not profit. It gives full relief below £1,000 and partial relief above. You cannot claim it alongside actual expenses on the same income. It is the wrong choice when your expenses exceed £1,000 or when you have a trading loss. Registration for self-assessment is still required when gross income exceeds £1,000. And a change to raise the reporting threshold to £3,000 is coming, but that is a filing change, not a tax-free income change. Know these rules, apply them correctly, and you will save both money and stress every single tax year. If this video helped you understand the trading allowance properly, please like and subscribe to HustleWise UK for clear, straightforward UK tax guides every single week.